Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the latest stories from Washington, D.C., including Fed Governor Cook appears to be back on the job, my interview with MCT's Phil Rasori on shifting coverage in response to policy and economic changes, the expansion of ARM and non-QM products, the growing role of AI in hedging and analytics, evolving tech freeing up staff for strategic work, and the rising demands placed on modern capital markets departments. And we receive wholesale inflation figures today before the consumer price index figures tomorrow. Thanks to today's podcast sponsor, Indicom. Indicom combines mortgage AI, intelligent automation, machine learning, and intelligent document processing with mortgage operational expertise to ensure that every solution is accurate, scalable, and impactful as it is innovative. Indicom's AI-powered tools like Income Genius, Decision Genius, and IDX Genius AI aren't off-the-shelf solutions. They're tailored and purpose-built for mortgage operations, trained on vast mortgage datasets, and refined by the feedback of operations teams, underwriters, and QC professionals. This practical focus means faster implementations, fewer errors, and a much shorter time to value. I hate it when my mom and dad fight, so I'm wondering if this Bill Pulte, Scott Besson, FHFA Treasury tussle will impact mortgage rates. Probably not. It hasn't so far, though Director Pulte is certainly in the news. Occupancy isn't a partisan issue, right? He continues to point out potential fraud by Fed Governor Lisa Cook, but has two close relatives who have declared the same owner-occupied status on two homes in two different states. Don't blame me for reporting that. You can read about it on CNBC and Reuters. Quote, Mark and Julie Pulte, the father and stepmother of Bill Pulte, since 2020 have claimed so-called homestead exemptions for residences in wealthy neighborhoods in both Michigan and Florida. Oh, and speaking of Fed Governor Cook, a federal judge late Tuesday temporarily blocked President Trump from removing her from the Federal Reserve's Board of Governors, allowing her to continue serving as she contests her recent dismissal. The Trump administration is intensifying discussions on the future of Fannie Mae and Freddie Mac as tensions rise between Treasury Secretary Besson and FHFA head Bill Pulte. It's an internal conflict that could complicate reform efforts, and the Mortgage Bankers Association certainly doesn't want Fannie and Freddie to merge. Treasury has launched a series of meetings with major stakeholders, including lenders, investors, and consumer advocates, to explore long-term changes to the mortgage giants, while Pulte is pushing for a near-term public offering of a small share of government-owned stock. The agencies appear to be pursuing separate strategies, with Treasury focusing on systemic reform and FHFA signaling more immediate steps, such as a potential IPO. Despite political noise and speculation, especially around legacy shareholders and skyrocketing stock prices, most stakeholders express concern about weakening regulatory oversight or merging the two firms, which could raise mortgage rates and reduce market competition. While no decisions have been made, the overlapping roundtables highlighted an emerging power struggle over who will control the path forward for the $7 trillion mortgage market. Bonds sold off yesterday after 4 days of gains that had sent yields to their lowest levels in at least 3 months, despite preliminary benchmark revision to payroll growth estimates from March 2024 to March 2025, revealing an overstatement of 911,000 jobs during that 12-month stretch. Ouch. The immediate market reaction to the payroll growth revision suggests refreshed worries about a potential stagflation scenario if inflation remains elevated while job growth continues to falter. Government data from before the revision indicated that the U.S. economy created roughly 1.8 million jobs in the 12 months preceding March, around twice what it now believes to be the actual number. The report adds weight to the claim that the U.S. is experiencing a weak jobs market and makes it more likely that the Fed will cut interest rates during its September meeting. Oddly, it had no obvious impact on rates. For today's interview, I wanted to welcome back to the show MCT's Phil Rasori to talk about shifting coverage in response to policy and economic changes, the expansion of ARM and non-QM products, the growing role of AI in hedging and analytics, evolving tech freeing up staff for strategic work, and the rising demand placed on modern capital markets departments. He's COO at MCT, and his areas of expertise include complex financial modeling, computational dynamics, and linear programming for operational optimization. He's functionally led MCT operations since 2005 and ascended to his current role as COO in 2007. I want to start by talking about kind of this different product expansion out there, and namely, I mean, ARM products, non-QM products. We've seen HELOCs have a huge renaissance as well, and I won't ask you the old, how do you hedge ARMs? That's more kind of a joke in trader circles, but we've seen these various products kind of come back to the fore or rise to the fore. How is MCT handling all of that?
We've definitely seen it. I mean, Robbie, you and I have talked over the years about how, every time from ARMS to non-QM, every time the market seems like it's going to move that direction, something happens. Either on the non-QM side, the market breaks, or we get a big old rally, and nobody cares about ARMS or non-QM anymore because they're just, tripping over agency refis. I think it's a little bit funny because we were just talking about this. Andrew and I, our head trader, we're talking about this in middle of July about we're doing an overhaul to some of the SOFR swaps and how that's shown in our model on the hedge side, and just relating to some of the ARM hedging and non-QM stuff. And we were joking around that the good news on focusing on all this is that it's going to create a rally, right? And it's kind of funny because we were, of course, just joking about that, but that was 2 months ago, and I just looked 2 months ago. We were at basically exactly half a point higher in 10-year yield. We were at a 456. Today, it looks like we ticked back down to a 406. So who knows? Maybe if we focus on it a little bit more, we'll keep dropping rates here. But yeah, I think that we are, this time does feel a little bit different, where there definitely seems to be more fungibility between investors. With these reliance letters, I think from our perspective, again, talking to Andrew, I hired him 20 years ago in 2005. It's hard to remember back that long, but in the hedge advisory world, it's not as fun when you have to deal with credit risk, right? We all, ever since, let's call it 2008, when everything became agency TBA based. I say this a lot, that we all take the TBA for granted. The fact that at the end of the day, there are some adjustments of spec and servicing value, but at the end of the day, you have this price of your asset, your loan that you're closing, that's really derived from the price of that hedge vehicle. And so it is definitely not as fun when credit risk is involved. But yeah, but to your point, Robbie, it does feel a little different this time, where, especially in certain silos of non-QM, I think the market's matured to a point where it could be here to stay.
Yeah, I'd like to believe so too. That is up until you look like COVID and it evaporates in a night overnight, and you're like, holy smokes, I thought it was a stable market. There's a lot you touched on there. For years, the non-QM drum, people have been beating it. Non-QM, it's great. I'm with you that it seems like it's here, and I wonder how much of that is Fannie and Freddie kind of their planned obsolescence, if you will, or they're receding from prominence. There's been some interesting stuff there where I've heard companies say, I'm not really selling anything to Fannie anymore, and it's almost by Fannie's design. And so you're seeing kind of this shift, and it's going more toward the non-QM space. People are better at finding income as they were at finding debt obligations for borrowers and being able to qualify that and qualify them. So that's neat there. On the 10-year treasury yield, I believe that 4.06% in terms of looking at technicals, that's the last level of resistance until 4%, basically. So imagine what that would mean for the messaging around the industry if we went sub 4 on the 10-year yield, and kind of the narrative out there and how it could spur people to get off the sidelines and all that. That's pretty neat. I don't even know where I want to go with this. Let's talk kind of coverage changes out there. There's a lot of uncertainty, and we've seen shape shifts of the yield curve as a result of, well, are tariffs going to be legal? Well, if tariffs remain legal, how much is that going to cause longer term inflation to rise? And as a result, we haven't seen longer term rates come down. There's the Fed rate cuts, which certainly the Fed next week will cut rates. That's only the short end of the curve. We've seen this labor market cool more rapidly than we thought it might have. If you were kind of trying to predict stuff in the spring, it's starting to rapidly fall off a little bit. You can kind of do hedging 101 here for us, because it's not like a lot the majority of listeners here are advanced traders like yourself or Andrew Rhodes. But when it comes to these times of uncertainty, kind of the importance of hedging or how your hedging model should shift or your coverage ratio should shift or kind of optimal hedging in uncertain times.
Just like I did. You covered a lot there, Robbie. I
Sorry.
think that no, I just to take a step back for so many years, and I know you've done this in the newsletter too, with your dad of trying to explain to people that the Fed dropping rates does not directly correlate to long-term rates dropping, which of course is our, what our mortgages are following for the most part on the fixed rate mortgage side. And so that's always a struggle to educate people on that. Well, what's interesting on this whole conversation of the Fire Powell trade, remember a couple months ago when that was all going on, you finally saw just the general market kind of realize that, whoa, you drop rates a ton, you could have a flip in a super steepening yield curve, and you could have a situation where long-term rates rise. And it's funny, another thing we were talking about this morning is it's basically a year ago exactly right when that happened, right? We had a drop in short-term rates, long rates rose, and it wasn't as fun as we all thought it was going to be. The good news now is it does seem, that it's real, job induced, the big, we had another, that higher than expected revision down the historical numbers. So I think that, it looks a little bit more durable from that perspective. But I think it's something we constantly have to remind our clients because everybody wants to talk about it, especially on the origination side. Hey, Fed's changing tune now. We just want to make sure that everybody's on the same page. That doesn't necessarily translate to long-term rates. With as far as coverage, look, it's a good point, especially with loans that are locked on for whatever reason the borrower got an unlucky reprice, or maybe it's a higher margin lock. As soon as we are starting to trend down, right, where you can see on potentially, with a little rally from here, you could have a sub 6% on some rate sheets, and if you do that, I think there's a psychological kind of trigger for the borrower, and so yeah, we definitely want to watch the expected flow downs. Borrowers, obviously, it's a vast majority of the market is purchased. They're really locked in for a lot of reasons that I'm sure you've talked about in the past a lot. But the last thing I'd say is, for those that say that, hey, for rate term refis to move at all, market has to drop to another 100 basis points in rate. And we just don't. I mean, the bottom line is, yeah, from a standpoint of getting the entire market to refinance, totally different story, right? Obviously, there's the lock-in of the super low rates of QE. With that said, the last 10 days, a rolling 10-day trailing moving average that we kind of look at for immediate locks, our rate term refis are up 290%. So
Wow.
it just shows you. Now, again, it all depends
That's
where you
low
start.
volume. That's incredibly low volume. Yeah.
Yeah, yeah. But I think, but we saw this on on when we did get a rally last year, too. You will see a spike up, and you'll see definitely improvement in some volume, even if we just stay here.
So I would say outside of the kind of refi boomlet that happened last fall for a couple days, we haven't really been in a falling rate environment in the industry for a long, long time. And it just kind of speaks to companies out there. Make sure your rate lock renegotiation policies are strong. Your float down policies are strong. Make sure all that's in line. Stick to policies and procedures when it comes to those sorts of things.
Robbie, on the rally, if I could just add one other thing that I forgot to mention to you, there's this whole side of the Ginny TBA, and the fact that now and this time around there's this FHA pay up spec, and that's a really interesting situation where now you have the TBA basically just BA loans. And the question is that TBA going to perform well if you get a big rally? Can those, as you get into those premium values of into 103, like, can it continue to rally, even though the world knows that they're going to get a lot of, a lot of Earls, and so it'll be it'll be interesting to see the performance. A lot of people think that that could be a problem on the hedge side.
Something to pay attention to because for people that aren't intimately familiar, FHA and VA bar was a lot different credit characteristics than some of these other subsets or spec pools that the people are buying. You and I spoke a little offline before we started here, and it's always good to catch up with you. But we were talking about AI, and we can't not talk about AI, kind of the developments, what it's allowing you to do from a product perspective, a tech advancement perspective, new features, new rollouts, those sorts of things. I think you said you could do stuff entirely within AI now if you're trying to roll out new products. I'm kind of bring people up to speed from the secondary marketing perspective, capital markets perspective, and when it comes to technology, just what's going on and how things are advancing.
Yeah, well, I think like all of our clients and your audience, Robbie, there's two sides. There's the client facing side. So for us, that's for lender facing. For our lenders, your audience, it's borrower facing, right? The client facing side. We worked on that at the beginning of the year. What we call Atlas AI. That's our AI product. It has some agent functionality. Back in May at the secondary conference, we did our first AI driven hedge recommendation and execution through it. So there's that side of it. But as we're all finding, there's also the internal benefits that you can get that are a lot of times right now as everybody figures out how to get these AI use cases into their current product suite. The internal values are actually a lot more in some cases. And so what I was talking about earlier is we have about 20 software developers that we have for the last 5 months or so been moving over to what's called an integrated development environment that's based in. They all use them, but this is a purely AI based one. This is called Cursor AI, and it's a very fast growing, popular environment for developers to work in. And what we've noticed that the productivity enhancements as these models are getting better is pretty incredible. And I do subscribe to those out there, those the household names out there that are saying that, hey, in 12 to 18 months, the vast majority, if not all, code will be written by AI. As I start to see the how this has improved over the last few months, it's the ramifications of that are going to be. I do think that'll happen, whether it's a year, 2 years, and the ramifications of that could be huge, right? Of being able to write that large, that much code in an automated fashion. So that's been big, and we've also seen it where our project managers have had a lot more deeper interaction with the developers because they're able to ask about the code base. So it's a lot of exciting stuff. So we're in the first, and the only other thing I was saying about that earlier, Robbie, is that I've been surprised at how hard it's been to drag some of these developers over to the AI side. There's been a lot of concern of effectiveness, but I think a lot of it's also some concern for self-preservation as well. So starting in September, we've forced everybody to make that change, and at the end of September, we're going to measure the difference in productivity versus September versus August. And I think it's going to be a huge change.
I would argue from the self-preservation front, it will benefit you as a developer to ride the wave rather than try and fight it. Like ride it and
Absolutely.
own it and get up and surf it if you want to continue the metaphor there. Let's talk productivity enhancements. You mentioned it there. It's not only for your team, but also your clients. And so kind of there's more free time, not free time, but you're freed up to do less tedious or menial tasks. And I'm wondering how you've seen that impact your relationships with clients, what clients have been freed up to do, kind of where we're heading for secondary marketing departments.
Great point. I mean, in general, the initial kind of concerns of moving, if we think of 2017 when we moved into BAM, which was our electronic loan trading environment, and then 2018 into 2019, our electronic TBA trading environment, TAM, which is now Agile. that was a huge concern of losing that personal touch, right? Of losing that conversation with the trading desk at either the broker dealer or the investor. And to your point, Robbie, what was interesting is you had more time for more valuable conversations than just the daily transaction or the hourly transaction of, hey, I got more loans, got to put on a TBA, got more loans funded, got to execute them. As that got automated, you had more time for more valuable kind of strategic conversations and relationship conversations, be it with your broker dealer or your investor. So that definitely is, and I know the question was more about now, but I think that that's just a perfect example of what I think we all expect to happen, on the AI side. So our next kind of goal is to keep putting more of the decisioning that our traders do into our trade agents. And so right now it's in testing where basically it follows along what our traders do. But I think that once we get to a point where we're all comfortable in getting that recommendation, there's just so much more. There's so many more data points, so much more granularity that could be pulled from the data. And so maybe some traders do it, but you'd be, to your point, you'd be spending your entire day, in a database looking at a loan, a group of loans versus doing some other more productive things for the organization.
We talked for so long about granularity, efficiency. These are the things that these tech platforms in the secondary markets can provide. Things are evolving so rapidly, though, with technology. What are the demands of a true modern capital markets tomorrow? What are your clients' demands of you as a tech provider? What is kind of the cutting edge of capability out there?
Yeah, it's a good question. I think our clients are always expecting us to find additional executions, right? MCT's, always prided itself on just execution, execution, execution. And so, look, you touched on it earlier with the agencies and that transition. The big one that's been, nice is seeing that private executions are there on the non-owners and the second home, some of those high LLPA products. And that's been really interesting to watch. And it's really our job to just go out there and again try to drum up these additional executions. I think it's a really good question on expectations, because I think that is, we talked about the benefits of AI, right? That you're going to be able to produce a lot more. I think we're going to get a lot more productive. I think we're going to be able to drive a lot more feature enhancements quicker. But the flip side to that is there's going to be a greater expectation, right? When you're a client, you want something in the past, there might have been a roadmap that might have taken 30 or 60 or 90 days to put that feature in. I think the expectations could change, right? They could be a lot more demanding, rightfully so, because there's ability to create it quickly. And I think, and again, I think it's good for our clients, good for lenders. I think you're going to see more competition in a lot of spaces, including capital markets.
I will close with this, I guess. Is there a nirvana when it comes to pricing and selling, or is that nirvana, quote unquote, always a moving target?
It's a great question. It has to be a moving target. It has to continue to improve. I think if we just focus on TBAs for a second, as you guys know, we're a big push, we push AOTs hard. The nirvana there would be that every loan that's committed or has trade associated with it, right? So there's virtually no pairing out of trades. That would make sense to remove that friction. But with that said, now you've got a whole nother part of the business that we talked about on the first part of this call. That's not even TBA based, right? So it's going to continue to change. And I think as the private securitization market hopefully continues to improve, I think there's going to be very interesting things there.
Yep. I'm in agreement with you that we'll start to see some of the private securitization space step up here as Fannie and Freddie go down whatever paths they're going down and those sorts of things. Always a pleasure talking to you. It's been too long, so I'm glad we did this and hope to have you back on soon.
Thank you for the opportunity. This was always great, Robbie.
Security prices are usually a direct factor of supply and demand. Yesterday's 3-year Treasury auction was notably strong, especially regarding foreign demand, featuring a stop-through of 0.8 basis points and a robust non-dealer participation at 91.6%, well above the recent 84.1% average. The auction stopped at 3.485%, significantly lower than the 6-auction average of 3.841%. Demand was solid with a bid-to-cover ratio of 2.73x compared to the typical 2.55x, and dealers took a smaller share than usual, accounting for only 8.4% versus their 15.9% average, while direct bidders claimed 17.4%, slightly below their 21.9% norm. It was indirect bidders who dominated, securing 74.2% of the offering compared to an average of 62.1%. Prior to the auction, treasuries were experiencing some selling pressure with yields near session highs, but following the auction results, yields eased slightly, reflecting positive market reception. The SOFR curve, and that's the secure overnight financing rate, it's a secured overnight interest rate, a reference rate established as an alternative to LIBOR, suggests that investors expect policy rates to bottom around 2.89% next year, reflecting hopes for a soft landing, avoiding both a recession and the need for aggressive Fed easing. This outlook assumes a gradual labor market recovery and manageable inflation, allowing a steady return to neutral rates. However, it may underestimate the risk that the Fed could need to cut more deeply if the economy weakens further. As the market flirts with pricing a 50 basis points cut, the conversation is likely to shift toward whether rates will fall below neutral. Today's economic calendar kicked off with mortgage applications increasing 9.2% from 1 week earlier, according to data from the Mortgage Bankers Association's weekly mortgage application survey for the week ending September 5th. The week's results include an adjustment for the Labor Day holiday. We also received the August Producer Price Index report, where wholesale prices unexpectedly declined 0.1% in August. Wow. Later today brings wholesale inventories and sales and treasury activity that will be headlined by $39 billion of reopened 10-year notes and a buyback for liquidity purposes in 5 to 7-year coupons for up to $4 billion. We start Wednesday with agency MBS prices approximately unchanged from Tuesday's closing levels, the 2-year yielding 3.54 and the 10-year yielding 4.09 after closing yesterday at 4.07%. Let's wrap up with a joke and some housekeeping. I'm reading a book on helium. I can't put it down. Thanks again to this week's sponsor, Indicom. Streamlining operations with the genius blend of automation, AI, and services, Indicom helps you achieve practical digital transformation and real operational impact with purpose-built mortgage solutions. To learn more, visit Indicom, that's INDECOMM.com.